Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday? All right. Hey everybody, Brian Foucher, and welcome to the presentation. Before I get rolling, I want to see who here is new to this presentation, hasn't seen the presentation before, or is new to the money multiplier, kind of new to this concept, and or as haven't seen me before. Obviously, I know like Yvonne and Tony and Shane. You know you guys, Patrick, seen you guys before. So is anybody on here is new to this? Is first time seeing this presentation? Like, okay, Jose, Leah. Okay, so we got some new people. Okay, awesome. Yeah, I love it when we have new people and all that stuff. So as we go through this presentation, keep this in mind. Ask questions. That's what this is for. It is to ask questions while also learning about this. I do pause while I'm doing the presentation. I do answer questions live as we're doing this. Doesn't matter if you're new or not. Please ask questions, because that's how we all learn, is by hearing other people ask questions as well. So, Robert, so you've seen this once a few years ago. Very cool. And that's 49 degrees in California. That's pretty cool for down there. Yeah, pretty crazy. San Bruno, though. Yeah. Awesome. Well, let's go ahead and get rolling with this. So my name is Brian Fouts. If I haven't met you before, good to meet all of you. I'll do a little intro here, not very much, but I do speak pretty quick. So keep that in mind. I get pretty excited about this concept. So I do talk pretty quickly. Now I am recovering from a cold. So if I sound a little stuffed up, that's why. So now, before we get rolling, there's a question I want to ask everybody, especially the people that are new to this presentation or new to what we're going to be talking about. Now, there's three things that I believe that we all should control in life. Now, there's lots of things we should control in life, but there's three main things when it comes to especially this concept that we should want to control in our lives. So anybody want to guess what those three things are, or one of those are? I know some of you know what the answer is already, but for those of you who haven't seen it before, what are three things in life that you want to control or think that we should control? Okay. Leah says money. Absolutely. So in fact, the first one that we talk about is money. Jose says time and money. That's corrected there. So the second thing we always want to control is time as well. Tony says my wife. Well, I'm not going to venture into that one. I'm not going to go that direction. But yeah, so time and money. Now, when you think about time and money, and by the way, and that says taxes. Yeah, taxes. Well, I kind of tie that one into money, by the way, because the more you control your money, the more you can control taxes. But which one of these do you want to control first? Time or money? Okay, well, the answer is money. You can't really control time if you don't control money, because a lot of people are trading time for money. If you're trading time for money, you're not really in control of both of these things in most cases. Now, we all trade time for money. Nothing wrong with that. I still do, by the way, but I love what I do, and I choose when I want to do it. And of course, Yvonne said the last one that we want to control is our mindset. What's going on up here? So as an example, I was talking to somebody yesterday about a concept, and the guy said, he goes, well, my wife says that's a scam. And he goes, well, how should I talk to her about that? Because I know it's not, but that's what she says. And I told him, I said, it's her subconscious programming. She's saying it's a scam because somebody else told her that. She has no experience in that industry or that field. So her saying it's a scam is not based upon her experience. It's based upon what her mindset is based on, is somebody else's belief. So yeah, so you want to control your mindset, because that can allow you to control money and time. So these are the three things we want to make sure that we do control in life. Now, I want to share this quote because it takes the three things and puts them into perspective. It says, the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. Like that wife is an example of that right there. People believe things that are not true, okay? So as we go through this presentation, I want you to keep an open mind because we're going to be talking about money mindset. And a lot of things that we've been taught about money are not true. Okay. They're just not true. That makes sense? Yeah. The rich are evil. Like that's a very common one, right? So once again, keep an open mind as we go through this presentation. All right. Now, I want you to think about this for a second. So let's just say that you put 118-year-old kids, call them kids, right, in a room and you ask every single one of them where they're going to be when they hit retirement age, let's say 65. Okay. Well, are they going to say, I'm going to be poor and broke? Of course not. No, they're going to say, I'm going to be successful. I'm going to be a multimillionaire. I'm going to be wealthy, all that kind of stuff. But here's the fact of the matter. If you fast forward to when those 18-year-old kids are now 65, only 5%, 5 out of 100 of them will be financially secure at retirement. Not financially free, by the way, just financially secure. Think about that. We live in the US, supposed to be the country of, all the opportunities you can ever imagine, right? One of the wealthiest countries in the world, yet only 5 out of 100 people at the age of retirement are financially secure. That is kind of scary. And that comes from the Social Security Administration, by the way. They're the ones that say that. So the question I want to pose to people, especially the people that are seeing this for the first time, is do you want to be one of those 5 people or one of the 95? So give me a 1 or a Y or a yes in the chat box if you want to be one of the 5% versus the 95%. Okay. So who wants to be one of the 5%? I know Yvonne does, and I know Jose does. Obviously, Tony, I know you do. Yeah, heck yeah. Yep, Jim says yes. Okay. Because when we say yes to that, then when we look at what we're going to be talking about in this presentation, the 5% are using this concept to be one of those 5%. It's one of the things that they do. So I want you to be aware of that. Okay. So they use this as to one of the ways to be financially secure because we want to be one of those 5%. Yep. There you go. Timmy says, please. Wade says, me too. Exactly. Okay. Now, real quick, who am I? So my name is Brian Fouts. I went to school and got a degree in construction management and business many years ago. I have not used that degree in over 10 years now. It's gathering dust somewhere in a box, right? But when I started off my life journey, I did it what I call the hard way. Okay. I was raised, lower income, but, great family, all that kind of stuff. But I was told to, follow that traditional path in life. Okay. Follow that traditional path, go to school, get a job, get a career in corporate America, start saving into a 401k, which 401ks, I will get into that on this presentation, but yeah, save into a 401k. Then I went and got that house. I got that growing family, all that kind of stuff, right? And I got all the stuff that came along with it. Okay. The mortgage, the car loans, I had student loans, all that kind of stuff. And I was being told that I was living the American dream. You probably heard that before. And if we ever talk, I'll explain to you where the American dream story came from back in the 50s. But anyways, it felt like the American nightmare to me. I honestly, it did, because I was just drowning in debt. I was not happy. I felt like I was just like working and slaving away for nothing. And what happened is I went to a doctor's office and I found this financial magazine. And I opened it up to a random article and it was talking about the millionaires. And it said the millionaires know their net worth. Everybody else doesn't in most cases. And I was like, oh, I don't know my net worth. So I'm probably not one of the millionaires. And sure enough, I wasn't. I went home and that's the piece of paper. I lost it, but I took a picture of it. I don't have it anymore. But I did my financial analysis of my life. And I was worth a negative amount of money after working for almost 10 years in corporate America. And if I did the math, I'd be worth less and less every single year going forward. It was like crazy. And then a really quick story, something happened. So it was my grandfather. He was my idol, man. This guy was amazing. He was a coach at the local high school and he coached my brother, coached, my dad, his son. And then he was working towards retirement at late 60s, right? And he's working really hard and he finally did it. He retired and he had this big dream. He's going to buy this motorhome, travel around the West Coast with his wife, my grandmother, and go to sporting events and his grandkids' sporting events. And he did it. He bought the RV and did that for like a year. And then only after a year, he got very sick. He got Parkinson's, leukemia, something else, and then he eventually passed away. And he couldn't even travel for the last, few years of his life. And he never got to live that life of retirement that he dreamed of. And it really hit me kind of hard. And it really told me that, hey, if I want something different, I've got to do something different. So that was a big epiphany for me that I had to do. And so fast forward many years later, after I left my career and all that kind of stuff and got into entrepreneurship, I've done some pretty cool things. This is just kind of show you that what's possible when you change your mindset. But this is one of my businesses back in COVID, by the way. I don't have this business anymore, but it did over $2 million of revenue in 2021. Actually, it was on the Inc. 5000 list and all that kind of stuff. So, but it took a massive mindset shift in my own life. And also this concept we're talking about helped with this. But yeah, so these are the things that are possible when you kind of shift the whole mindset. And it's allowed me to do a lot of cool things in my life. I like experiences, by the way. I'd rather control time than money, by the way. Time is my big thing. So I love having a lot of experiences. I've got 3 kids. Their oldest is 14 right now. She's actually homesick right now because we've all got kind of a cold. But yeah, I love to travel. I love classic cars. You guys can't tell that. But yeah, so that's part of what I do. And then that led me to learning about this concept. So doing all that stuff, and I used to speak at events. This is like a high level mastermind where I would speak on this concept to people in the audience and help them understand this concept. So I really love talking about this strategy. So let's get into it. Okay, so who else talks about this concept? Okay, well, you guys have probably heard of Robert Kiyosaki. So in his book, Second Chance, he actually talks about this concept. And actually one of his advisors was my mentor. So I know a lot of his advisors, but one of his was one of my mentors in this concept. Tony Robbins, I've been to a lot of his events. He talks about it in his book, Money Master the Game. Nelson Nash, he's the one that kind of built the foundation of this strategy back in the 80s. So our Nelson Nash, that's a great book, by the way. So I do recommend these books. And then, of course, one of my friends and mentors is Brent Kessler and Chris Naugle. They have a book called Mapping Out the Millionaire Mystery. And then Chris also has one called The Private Money Guide, how to blend from your banking system. And so, by the way, if you guys want these 2 books on the very bottom as a PDF, I have a link to that. So at the very end, towards the end of the presentation, I'll put a link in there or my email address, and I can email you guys those PDFs if you guys want those. But I definitely do recommend these books. Yeah. All right. Now, who has used this strategy throughout history? Well, Jim Harbaugh, he was paid his salary and his bonuses through this strategy. So the college actually paid him with this concept. It's very cool. This gentleman, he probably doesn't remember where he's right now, but his name is Joe Biden. He has 4 of these kinds of strategies or these policies, okay? Or maybe it's 6, 4 or 6. He owns quite a few of these things. By the way, politicians, wealthy people, they all use this concept. Walt Disney, kind of cool. So Walt Disney, back when he was trying to start Disneyland, he couldn't get a loan for this strategy, right? To do this. And so he ended up using his own banking strategy to get a loan for Disneyland. And that's how he started Disneyland. Yeah. So Shane says, yeah, the first one, you need to get the first one. Yeah, I like that one. I like it better than the first one too, by the way. Also, so Ray Kroc, you guys know who Ray Kroc is. He actually used infinite banking, this concept, for the first 8 years when he took over or was doing that takeover of McDonald's to fund it while he grew it. So without this concept, we probably would not have McDonald's as we know it today, which is kind of cool. Pampered Chef, she borrowed from her policy to do Pampered Chef. And then, of course, it got acquired by Warren Buffett for a lot of money, billions. And then, of course, lots of wealthy families do this. And Morgan's, JP's, the Chases, Vanderbilts, Rockefellers, and the Harrises, and now you. And if you don't, you're questioning whether they use this or not. In that video where I was doing that presentation, one time when I was doing that, this is like 6 years ago, there was a billionaire in the room. And I gave the presentation on how families use this for generational wealth and for the kids. And he came up to me afterwards and he said, yeah, you're exactly right. I do this. And by the way, that billionaire was the first shark on the show Shark Tank. And so it's kind of cool to have someone come up and say, yeah, you're exactly right. This is how we use it and how I use it in my own life. Kind of cool. All right. So what will infinite banking do for you? So 1, it creates guaranteed generational wealth, tax-free, by the way, tax-free day 1. Like a 401k does it down the road, this does it day 1. It allows your money to grow uninterrupted, compounded, which I love compounding, for the rest of your life, guaranteed. So uninterrupted compounding means that no matter what you do with this strategy, you're going to earn uninterrupted compounding for the rest of your life. And there's guarantees tied to it, which is amazing. It takes control of your money away from the big banks and Wall Street and puts that control into your hands. Remember, we talked about control, okay? Control. This puts it into your hands. It protects your money from lawsuits, from bankruptcy, from divorce and creditors in most states, by the way, which is a nice thing. It's why I moved to Idaho recently from Washington State. It's why I'm opening up another policy now, because I didn't want to do it in Washington State because they don't have the best protection. They do have protection, but not the best. So sorry, Patrick. It allows you to be the bank for things that you may normally use a bank for, a traditional bank. So think of things like investments, retirements, college, cars, homes, all those things, but while still having all of the benefits listed above. So let me ask you a question. Would you want to have all of these things at the same time, or just one or two of them? So you want to have all of these things in your life at the same time? Give me a yes, give me a one in that chat box real quick. Because it does all these things at the same time, not just one or the other. If you think of like a 401k or an IRA or something like that, or pension, it does maybe one of these things, maybe a two if you're lucky. But this concept does all of them at the same time, which is amazing. Okay. Yeah. All right. And Shane, I like your comment about money master the game. Yeah, I mean, when you hear this for the first time and it's not explained to you like the way that I'm doing right now, it sounds like a completely different language. It sounds kind of weird. When I first read that book, it didn't quite click when I first read it, but read it again after I knew this, and it made sense. Yeah. All right, so don't take out a pen and paper, but what I want to make sure you guys do is do ask questions. Use the Q&A box or the comment box, however you want, but ask questions as we go through this. Okay, now real quick, I'm going to go through this pretty quick here, this next step, but these next slides. So as we go through this, I want you to understand, keep an open mind. So the backwards bicycle, we love this example because it's pretty funny, but imagine you have a bicycle that when you turn the handlebars to the left, the front tire goes to the right. Okay, there's a video on it. You can Google it after the presentation called Backwards Bicycle. It's hilarious. The guy tries to ride this bicycle, and we all know how to ride one, right? We learned as a kid usually, but he tries to ride it and he falls down. Okay. And Leah, the part is the interest, the dividends. Yeah, so the cash value. So I'll show you that is here in a moment. But he falls over all the time because he's programmed to ride that traditional bicycle. But after time, like 6 weeks or 6 months, he learns how to ride the backwards bicycle. He reprograms his mind on how to ride this different way of a bicycle, right? Different way of thinking. Now, what's funny though, is that he gets back on a regular bicycle and he cannot ride the regular one anymore. Okay. So think of this concept we can talk about like around money, kind of the same way. Once you learn how this works, it's kind of hard to go back to the old way of thinking around money. Okay. So once again, keep an open mind. All right. So why are more people successful? Remember we talked about the 95% versus 5%. So here's why. The wealth killers, taxes, right? Taxes. I don't mind paying taxes, but I'm a lot happier paying a lot less. This has strategies around that. Okay. Inflation, which is inflating of the money supply. Volatility, ups and downs in the markets. Interest is one of the biggest killers, by the way. If you're bleeding interest out to other people, you're not controlling that money. Okay. Yeah. Miss Mark says the same thing about roller skates to skate or roller blades. Yeah. I still can't ride this, by the way. I've never really tried all that much, but yeah. Mindset, follow the status quo. Not a good thing to do, by the way. Keeping up with the Joneses. Fear or FOMO, fear of missing out, life in general, and then what we're taught. So these are all the things that kind of keep us from being successful when really we should be more successful. Okay. Okay. So let's think about this for a second. What's the definition of money? It's just a tool, right? It's just a means for exchange. Call it, dollar bills. It could be seashells. It's just whatever we give value to it, right? Right now, fiat currency, by the way. All right. Which we won't get into that. Now, what company uses compound interest? People say banks, by the way. Banks don't use compound interest. They don't really use it. They will earn it, but they don't use it. Okay. If you give your money to a bank, by the way, and put it in the back, vault, they don't write your name on it, right? What they do is they put that money to work. So they money in motion makes money. So that's what banks are doing, right, with their money. Okay. Are your dollars worth more today or in the future? Well, with inflation, we know that our dollars are worth more today than they are in the future. Think about candy bars today versus candy bars 20 years ago. How much would a dollar buy you? Well, back then, maybe a couple. Today, maybe half a candy bar, right? If you're lucky. Okay. Will taxes go up or down? I don't even need to answer that question, right? They're probably not going to go down. They're going to go up. Now, here's a question I want you to think about. Would you go and buy bread or buy milk and then wait to eat it for like 2 or 3 years, put it in the freezer and then take it back out down the road? No. Okay. Would you go buy a car for $30,000, like a Honda Accord, a general car, and put it in the garage for 5 years and then start driving it? No, yeah, eggs. Yeah. I don't think I want to freeze eggs though. Good one though. But yeah, you wouldn't do that with a car. Okay. If you're going to buy a car, you're going to use it today. But here's the thing. When you take money and you put it into a 401k as an example, or an IRA, what are you doing? You're putting that money into a vault that you can't really access, and then you're going to use it down the road. So it's weird. We will do that with money. Okay, we'll put it into something like a 401k, IRA, traditional plan to use it down the road, but we don't do that with things that money buys, like a car or food. We'll use those today because they have more value today. So in a 401k, your money has more value today, but you can't use it until down the road. So let me ask you a question. This is a great one. Let's say you're a farmer and you're going to go buy $1,000 worth of seeds. Okay. You're going to go buy these seeds and you're going to plant those seeds. And then let's say 6 months down the road, you're going to harvest that crop for $10,000. Okay. You're going to make $10,000. Would you rather pay taxes on the $1,000, the seed, or the harvest, the $10,000? Imagine that. So give me a 1 if you would want to do it on the, there you go. Yeah, Shane says the seeds. Yep, exactly. You'd rather pay taxes on the seed, not the harvest. So, yeah, that's exactly what a 401k is doing to you. You're paying taxes on the harvest, not the seed. With this concept we're going to be talking about today, it's the opposite. You pay it on the seed and not the harvest. Okay. Mindset shift right there. Mindset shift. Okay. All right. So let's talk about really quickly how money flows. So I want to use an example of a buying a car because most of us have bought a car before. So let's say you're going to go buy a $25,000 car. And let's say that you happen to have $25,000 in the bank earning 4%. That'd be awesome, right? If it was guaranteed, but no, it's not. Let's say you do that. And you're going to go to the bank, the banker, and say, Mr. Banker, I want to take out $25,000 to buy the car. But the banker says, hey, wait a second. If you do that, you lose the 4%. You don't make 4% anymore. So what if I did this? What if I do this? I'm going to give you a loan of $25,000 at 6% for 60 months, traditional car loan, right? And you'll keep the cash in the bank earning 4%, okay, as the collateral. So in this scenario, does that make sense to do that? Now, assuming, of course, you're going to pay back the loan, of course, you're going to keep funding it. If you took cash out of the bank, you would take the money and put it back into the bank to build the cash back up again, okay? So what happens if you did this? Well, your payments back on the car loan are going to equal $483 per month, and the future value of those payments that you're going to pay back to the bank is $28,999. Let's just call it $29,000, okay? Now, the money in the bank, though, is earning 4% while you're paying 6%. But here's the math. The future value of the $25,000 is $30,525. So what's that mean? It means that you made $1,526, and yet your cash flow did not change at all. In one scenario, you paid $25,000 and you put $25,000 back. In this scenario, you make $1,526. Okay. Now Leah says, full coverage, don't forget insurance. Yeah, that's outside of this system because you're going to have the car no matter what. Doesn't matter if you finance it, use cash, you're still going to have that expense outside of it. Yeah, but good point. Correct, Jose. With this concept, we do not pay taxes on the gains. That's exactly what we're talking about. Yep. Okay. So what we're going to be talking about is the money multiplier method. Okay. So the first part is the machine. What is the machine that makes this work? Okay. The second part is the marathon. It's not a sprint. It is a marathon. Building wealth doesn't happen overnight for most people. Okay. And then the millionaire. Okay. How do you build wealth, lasting wealth with this concept? Okay. All right. So let's talk about the machine. So what I want you to think about is this. So infinite banking, that's the concept we're talking about, becoming your own banker. So the infinite banking concept, think of it like a car. Okay. A car has tires, headlights. Hopefully it has brakes, it has seats, mirrors, windshields, a radio, all these kinds of things. But what if that car, the infinite banking concept, has no engine? Can it function? Can it go down the road? Can you use the radio? Most likely not, right? You can't use it. It has to have the engine. So in this case, the engine for infinite banking is nothing more than a permanent dividend paying whole life insurance policy, specially designed with a mutual insurance company. Okay. That's what it is. That is the engine that makes this work. Okay. Now, yes, we're going to talk about the engine, but the part that is important is the car, the infinite banking concept, right? Because when you go buy a car, yeah, you want to know what the engine is, but once you buy it, are you looking at the engine? Are you doing much with it? No, you're driving the car and doing all the features that the car does, right? It drives, has brakes, air conditioning, heater. You're using all those things. The engine, though, makes it go. Okay. So now when you think, why life insurance? Well, here's kind of the funny thing. So people think like, well, what if I'm young? I don't need life insurance. Or what if I don't have, kids? I don't need life insurance. But here's the thing. We're not talking about life insurance per se. Yes, we do, but it's the infinite banking concept. Now think of this. Who's the biggest purchaser of dividend paying whole life policies? It's banks. You can go Google BOLI, BOLI, bank owned life insurance. All the big banks you see in any major city, they all own more whole life insurance than they do their real estate and their buildings combined. So if they're doing this, why aren't we doing it, right? So what do they know that we don't? Well, they know how this thing works, okay? All right. So we talked about how you can make money earning 4% while paying 6%. We already went through that example, okay? So just kind of, once again, I want to hit on that, make sure you understand that. That is what we're talking about, okay? So now, what I want you to understand is, what do banks do with your money? So most people don't understand how banks function. Now, they are very complicated, companies and stuff, but let's keep it kind of simple. But here's what happens. So let's just say that you give $100,000 to a bank at 4%, and they're going to pay you 4%. For the bank, that is a liability. It's not an asset, by the way. It is a liability. So kind of keep that in mind, okay? So it's a liability. But they don't just sit there on that $100,000, right? What do they do with it? Well, they loan it back out at maybe 7%, okay, on a home, or 4% or whatever. They loan it back out again. But what does the home seller do? Well, the seller takes the money, puts it right back into a bank in most cases. What's the bank do? Same thing again, right? They put it right back out again, maybe on a car loan, maybe at 8% or something like that, okay? What's the car company do? Puts the money back into a bank. They pay people. What do the people do with the money they get paid on? Back into the bank again, okay? What's the bank do? Maybe they do a home remodel loan or something like that. What's the contractor, the subcontractors, the workers do? Put the money back into the bank again. The bank just keeps that money rolling and keep it moving. Maybe it's a debt consolidation loan at 12%. Get rid of those 20% credit cards. We'll give you a 12% loan. Well, guess what? Credit card company goes right back into the bank again, to the tune of 500%. So what I mean by that is, the bank is paying you 4%, but they're making 500% more than they're paying you, because they're making around 20 to 25% on your money while paying you 4%. They do that because they put that money into motion. They also do fractional reserve banking. We will not get into that, though, on this conversation, but the banks are keeping your money in motion. That's why they like it when you put money there. It's why they don't want you to take it out, because they put it into motion. Okay. So that's how banks make money. Because I ask this question quite a bit for some people. Why do banks exist? Think about that for a second. Why do banks exist? A lot of people will say they exist because we have to put our money somewhere. They exist to give loans. No, a bank exists to make money, make profit, right? For stockholders, for shareholders, for owners. That's why they exist. And this is one of the ways they do that. Make sense? Okay. All right. Yeah. Tony says, yeah, what we're taught. Yeah, it's what we're taught. Yeah. People think that McDonald's is a fast food company. Yeah, they are, but how do they make money? It's off of real estate, by the way, because they own more real estate, I think, than almost any other company in the US or something like that. They own an insane amount of real estate, and they lease that to the what do they call that? The franchisees that own the McDonald's, but they don't own the franchisees don't typically own the land. McDonald's company owns the land. Kind of weird. Yeah, ever see a poor looking bank building? Yeah, not very often, right? Yeah. So banks, by the way, they make between 400 and 1,300% on your money. And you can go to bauerfinancial.com and look that up if you want. And you can go back and look at history to see how much they've made off your money. It's crazy. No bank has ever made less than, I think, 400% off of your money. Now, granted, they do other things that are very nefarious, like, what happened back in the, 08, 09. But yeah, I mean, banks are over leveraged, in my opinion, and they do very crazy things like fractional reserve banking. So they're not very stable. But yeah, they do make money off your money. Now, real quick, annual pattern of spending. So when we look at what we spend money on, around 20 cents of every dollar goes to automobiles, okay? Around 30 cents goes to housing, think rent or mortgage, things like that. And then 40% of every dollar goes to everything else. So automobiles, housing, and everything else, think like travel, entertainment, food, clothing. That's 90 cents of every dollar that you make goes out to somebody else in most cases, okay? And right before COVID, I think the average savings rate was like less than 5% or something like that. It was like 10%. So I say that maybe if we're lucky, we save 10% of what we make. Maybe. Okay. And during COVID, it was a completely different number, by the way. It's crazy. But yeah, so think of that. 90 cents of every dollar goes out. So when we think of infinite banking, we want to reverse this a little bit. Okay. So let's start with the savings number. Now, when you go talk to a financial advisor, they talk to you about your spending patterns, not your savings patterns in most cases. So let's start with the savings first. Okay, now I said that 20 cents of every dollar goes to automobiles. Well, here's the thing. 5 cents of that 20 is interest. So what if we recapture the interest back into our own savings? Okay, our savings would go up. Okay, housing. Now, housing is different. So you think of housing, 30 cents of every dollar goes to housing, but 25 cents of that is interest. Okay, that's amortized mortgages, by the way. They are very dangerous. Most people don't understand how they work, but they are very dangerous. On a mortgage, 80% of your payments for the first 7 years goes to interest. So if you say that, hey, I've got a 2% loan or a 3% loan or a 5% loan, please explain to me how 80% of your payments are going to interest in the first 7 years. It's very crazy how you think about that. Okay. Now, if 25 cents is going to interest, let's recapture that. Okay. So now you just added more to your savings. And the last thing is everything else. 40 cents of your spending is going to everything else. Maybe 5 cents is interest. Let's capture that back into the savings. Okay. So when you look at this, this is why we want to look at infinite banking, because when you are the bank, you now control the interest and you can benefit from that. Make sense? Okay. So I want to give an example. I'm going to use a car as an example because most of us have bought a car. So we're going to look at how you can get the money back for a car. All right. So what you'll see here on the right-hand side is a policy, call it illustration. It's called a tabular detail for a policy. Now, when people think of insurance, they think of expenses. They think of, I have to pay a payment. Well, when you look at this, when you put a money into a policy, you get return out of it. You can take money back out. So we think of that as a deposit, not a payment. So it's a premium deposit. Okay. Age. So people think, well, Brian, I can't get a policy because I'm 60 years old or 65 years old. Not the case. You can still get policies. You can actually get them on other people, by the way, and you own it and use it. A lot of people focus on the death benefit. Now, we're not going to focus on the death benefit because that is a end of life benefit. We want to focus on the living benefits. Make sense? Because these policies have a lot of living benefits that a lot of people don't know or even know exist. Okay. So let's talk about that with buying a car. So, all right. So in this example, we're going to deposit $10,000 a year into a policy. Okay. Yeah. And by the way, Tony right here, he said that he got his near his 60th birthday, his first policy through me, by the way. So yeah, it's awesome. So we're going to put in $10,000 per year into a policy. Now, someone says, well, where does that $10,000 come from? It could be money that was going to a 401k, money going to savings, could be disposable income. Doesn't really matter. We just want to grasp the concept. Okay. We want to grasp the concept. Okay. Now let's say that in year 3, you go to your bank, which by the way, has what's called cash value in the account. Okay. And you borrow $25,000 from your bank. Now, this is your money, by the way, but you borrow it back out, okay? Because you have cash value. Now, because you are a responsible banker, you're going to pay back your loan like you would any other car loan. Now, you can choose how you pay it back, by the way, because you're in control. You want to make no payments? That's fine, but you probably should, okay? So let's pay it back at, let's say, $500 per month, $6,000 per year. So what does the math look like? Well, after 7 years, you've put in $70,000 into your bank deposits. You've paid back $30,000 on the loan, on the car loan, okay? But you've also taken $25,000 out in cash. Now we said go buy a car, but what if you put that into real estate? What if you put it into an investment or whatever? But let's just use the car example, okay? So in reality, you've put in $75,000 into this policy, yet you've captured 91 cents of all of the money you put back into it already. You've already captured that money. It has not left your control, okay? You still have it. And you have the car. Now, let's look at the next set of years, okay? Because keep in mind, marathon, not a sprint, but let's look at the following years. Now, you can, if you so choose, to put nothing into this banking system after year 7. You can put in 0 if you want, or you can keep funding it. It's up to you. But let's just say we put in nothing. Now, here's the amazing thing. Because there are dividends, because you're part of the banking system, the insurance company, your cash value continues to grow, okay? So what does it look like in year 8? Let's say you buy another car, or you sell that one and go buy another one through your banking system. Okay, $25,000. So we pay back that same loan again, like we would. So what does it look like in years 8 through 12? Well, you've put $30,000 back into the policy, essentially, or back into the banking system as a policy repayment. but you've also taken $25,000 out. So in reality, you've put in $5,000 into it in years 8 through 12. But if you look from year 7 to year 12, the policy cash value went up by $23,000, $23,592. So let me do the math on this really quickly for you. You put in $5,000 in years 8 through 12, yet that $5,000 turned into $23,000 and change. Also, if you do the math on this, you've put in $80,000. That is the $75,000 from years 1 through 7 and $5,000 from years 8 to 12. That's $80,000. Yet the cash value that you control in the policy is $91,000. So if you do the math, and by the way, this is a very conservative numbers. They're very conservative. I want to keep them low. Okay. It's usually a lot better than this. But in reality, $80,000 turned into $91,000. So you actually had a gain of $11,000 and you own 2 cars outright. So you have more net worth and yet you own 2 cars outright. So hopefully that makes sense. Let that sink in for a second, because that is pretty cool. Okay. All right. So there's 3 rules when we talk about, infinite banking. 1, fund your banking system. Rule 2, make sure you pay back your loans. And rule 3, keep that money working for you. Okay. So what are those? Pay yourself first. Okay. That's the first one. Pay yourself first. Okay. The second one, pay yourself with interest. Okay. You're paying back the insurance company, but pay that back, right? Because you're going to benefit. And then recycle and recapture your money through the policy, because you are going to build wealth doing this. Okay. And Shane said it right there, the power of compounding interest and paying yourself back like a bank. It is incredible. Okay. All right. Now this works for a car. Okay. Now that could be real estate or, something else that builds wealth or builds cash value or cash flow. But the other thing that a lot of people do, because it steals a lot of wealth, is debts. So debt or interest steals wealth away. Okay. It just does. So,
you ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you've felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com. Sign up.
One of the first things, if you want to really use this and build wealth, one of the first things a lot of people do, not always though, but some people do this, is they pay off debts first or recapture that debt back into their own control. So now they control it and they're going to benefit from that. So let's look at an example here of paying down debts or paying off debts quicker. So in this example, we're going to use this is a chiropractor or a dentist, I can't remember, but this individual, I think he's in his, when he built this, it was in his mid 40s, I think. $478,000 of debt. Okay. The total payments are almost $6,000 per year, or $69,000 per year in payments. Okay. This is a doctor. Keep that in mind. Doesn't matter if your debt's, $10,000 or $1 million. Okay. It doesn't really matter, but this is this example. Now, if this person paid these back as scheduled, it would take 19 years. That's a long time, by the way, 19 years. Okay. So let's look at how this would look with an infinite banking policy and capturing this. Now, this doctor, he was taking money and socking it away into like a solo 401k, an IRA, and some other things. Now, he didn't like those vehicles because they weren't performing very well and they went up and down with the market. So he said, hey, I'm going to take that money and redirect it back into a policy instead. So how much was that? It was $25,000. So he's taking $25,000 per year. That's his premium deposit, by the way, and put it into the policy. Now he's doing that on an annual premium. You can do it monthly or quarterly, annually, but he's doing it on an annual basis. And this is a conservative policy. So day one, he does this. He has access to 14,000 and change of cash value. So what does he do? So we show him how to do this. We mapped it out for him. So he takes that cash value out and he knocks out the Discover card, Lowe's card, and part of Nordstrom's. Okay. And KM, yeah, I can compare it to a self-directed IRA in a moment. Yeah. So that knocks his debts down, but also what happens is his monthly payments drop. So they drop by $448 per month. So what do we do with that $448? Well, we want to maintain control of it. So we control that $448 per month and we put it back into another account to capture. We recapture, okay? So now, what do I mean by that? Let's look at year 2. In year 2, another $25,000 premium deposit goes in. but the cash value goes up by more. So it goes up by 16,000 and change. Okay. So that's what he has now in the policy because of dividends and all that kind of stuff. The payments back to himself, that $448 per month, is $5,374. So the total cash that he now has access to is 21,000 and change, almost $22,000. So what do? Borrow back out. Nordstrom card gets wiped out. The Wells Fargo card gets wiped out. The private loan gets wiped out. Okay. Now his debt just reduced and his monthly payment now dropped by, let's see, $1,917. Okay. Cam, yeah, there's a minimum and maximum. I do get into what those numbers are in a little bit. Yeah, so I'll get into that in a little bit, but yeah, there are. So his monthly payments dropped. Okay. Now keep in mind, he's still got 3,860 going to the remaining debt. So keep that in mind. Okay. So it's not like nothing's changed. His cash flow has not changed at all. Okay. All right. So that's year 2. Let's look at year 3. So in year 3, he does another $25,000 deposit. Okay. Keep in mind, this was money going to other buckets. Now it's going to this bucket. Okay. The cash value grows by $25,000 and change. Okay. The payments of $1,917 back to his separate account equal 23,000 and change. Total cash he now has access to is $48,545. Okay. So same thing happens again. Keep in mind, his cash flow has not changed at all in this scenario. Okay. Now he wipes out BMW, wipes out West Marine, probably a nice boat, by the way, and then wipes out part of the condo. His monthly payments have now dropped to $2,100. Now he's recaptured $3,677. Okay. Now, before I get to year 4, what I want you to understand is this. Okay. So how much has this doctor in the first 3 years put in? $75,000. Okay. How much has he taken back out? Around $55,000. Okay. How much does he have inside the policy earning dividends? Nancy? Yep. It is an amazing tool. Exactly right. So here's the answer. I'll just get through this really quick. How much is left in the policy earning dividends? Some people would say 20,000, but the way that we do this, you're still earning dividends on $75,000, meaning that you have not interrupted the growth of the strategy. I don't know of another vehicle or instrument that does this, by the way. Pretty cool. Okay. Let's get back to it. Year 4, same thing happens. $25,000 goes in. Cash value goes up by, let's say, 26,000 and change. Payments back to himself of the 3,677. That equals $44,000. So now total cash is 70 grand. Now, here's the interesting thing in this year. When he takes that loan back out and pays off the part of the condo, the monthly payments don't change because the condo and the house are mortgages. They're amortized. If you pay the principal, the payments do not change, which is another thing why I love mortgages. Not really. All right. So now year 5. Okay. Year 5, same thing. 25 goes in. Cash value goes up by 27,000 and change. Payments back to himself are 44,000 and change. Cash available to take back out is 71,000. That's what he does. Now he wipes out the condo and wipes out a big portion of the house. Okay. Monthly payments have dropped to only $1,221, which is the house, by the way. Okay. And he's saving $4,500 approximately. So in year 6, now here's what happens. Now in year 6, this doctor, this is what he did. He said, hey, this is amazing. This is awesome. But in the last 5 years, my income has gone up. I've got more disposable income. I don't want to put it into the markets. I don't want to put it into 401k. I want to put it through another banking policy to get this thing rolling even faster. So he opens up a second policy. Now, on the first policy that we did for him, we dropped the premium deposits down to only $10,000. Okay. So you can do that. You can drop them down sometimes. So he dropped it down from $25,000 down to $10,000. But here's the amazing thing. He puts in $10,000. The cash value in that first policy went up by $13,000 and change. Went up by more than he put into it. He starts the second policy, puts in 25, has access to 14,000 and change. Okay. Payments back to himself are $54,678. And the total cash is now $82,000 and change. Okay. The house is only $76,000. So what's he do? He borrows $76,000 and wipes out the house. His payments are now 0. He's recaptured $5,777. In year 7, what's he do? In year 7, he takes that $5,777 number and he pays back the outstanding policy loans on his policy. At the end of year 7 or 7.5 years, he is 100% debt free and has multiple 6 figures in his banking policy that he can now go use to go do real estate, go do investing, do whatever he wants. Okay. And he has more cash value than he's put into the whole entire thing. His wealth has gone up tremendously and he has no debts, and it only took him 7 years, not 19. Now, if you're saying, well, Brian, that sounds cool, but how the heck did he map that out? Well, we showed it to him. So we actually have a software that does this and many other things called the Debt Blaster. So we map this out for our clients. There's no cost, there's no fees, nothing like that. But yeah, so we map this out for people, and then we have a full team that actually shows you how to do what I just talked about. So it's called the implementation team. Even I can show you, but yeah, so we can really show you how this works and map it out for you so that you do it the right way. And so Shane, great thing right there. Said that, the huge shift in time and net worth. Exactly. And Shane has, experienced this. But yeah, it's a huge shift. Huge shift. Yeah. But once again, though, how'd you do it? Control of money. You got to control your money before you give it to somebody else. Okay. Now let's talk about the last thing, the millionaire. Okay. So what if I don't have any bad debt or debt? What if I don't need a new car? Can I still benefit from privatized banking, and should I become my own banker? Absolutely yes, because once you do that, you pay off those things, that's when the fun begins, because that's when you start to build wealth. You start creating that legacy and investing and stuff like that. But you got to get through that first steps first, okay? So here's some things that, that our clients use to create wealth and do things, right? So active real estate investors, wholesalers, flippers, buy and hold, commercial properties and mobile home parks. In fact, oh gosh, I think it's this coming weekend, or I don't know when it was, but Hannah, one of our big team members, she was actually in Florida, or she's going to be in Florida, and they're going to be touring mobile home parks that people are going to buy into. So there's lots of things. Private, real estate, lending on real estate is another way to do it. So it's basically using your bank to become another bank. Business owners do this a lot to control the cash flow of their business or grow their business. Stocks, some options traders do this as well. Startups, and then even equipment flipping. We have a partner that does equipment flipping for like forklifts. You can buy a forklift, fix it up, and then lease it out or sell it for profit. Lots of ways to go do this kind of stuff. Oh, so yeah, so Tony, you did the bus tour. So it was last weekend, right? Yeah, last weekend. Forgot what it was. Yeah, we're Tuesday already. But yeah, so there was a bus tour, and they went and looked at mobile home parks, I think, if I remember correctly. But yeah, so there's lots of things that you can do. So Cam, so there's a couple of questions in the Q&A section. How can you compare this to self-directed IRA? Oh, you looked at houses, Tony? Okay, 10 houses. Can you compare this to self-directed IRA? There are different vehicles, by the way. So an IRA is a retirement account under the control of the IRS. So when you put your money into an IRA, you give up kind of control of it. And then unless you have a self-directed, but self-directed can allow you to put it into real estate, things like that. But you can't benefit until you're 59 and a half. You can't take that money out without penalties, without, other, repercussions, taxes, all that kind of stuff. So with an IRA, self-directed, not a Roth, by the way, with an IRA, you're putting money into it pre-tax, and then when you pull it back out down the road, you're going to pay taxes on the larger balance. And there's no way to control that. You don't control it. An IRA is also a public strategy, meaning that people can see it. Okay. And it's an asset that you have, but they can see it. It's not protected in most ways. And so with an infinite banking, though, it's protected, it's private, they can't see it, and you control it, and you pay taxes before it goes in, not when it comes out. So different that way. Yeah. Yeah. So it's a killer penalty. Yeah. So Tony said, yeah. And he started his at 60. So he was at that 59 and a half mark. But once again, I mean, you can't benefit from it. With infinite banking, by the way, you can go do the same things with the self-directed, like real estate, but you can take the cash flow. So you can benefit that way. Otherwise, the IRA has to take the cash flow. Is there a minimum or maximum you can deposit per year? Yeah, I'm going to get into that, but it's minimum is usually 10 times your age per month. So yeah. All right. So what I want to do right now is I want to give you all an example of, infinite banking. By the way, I'm going to put up a link here in a moment with my personal call link. So if you guys want to hop on a call with me or send me an email, anything like that, I'm going to show you how to do that here in a moment, because there's nothing else to buy, there's nothing, no purchases, nothing like that here. But I want to give you an example of infinite banking when it comes to private lending. Okay. So this is what's called a tabular detail, okay, of a policy illustration. Let me bring up my laser pointer. There's right there. Okay. So you're going to see a couple things on this. You're going to see some cash value on this side, cash value on this side. So we look at the right-hand side of these things, by the way. That's called that's where the dividends are. Okay. So in this case, this person put in $50,000 per year. You can see it right there. Okay. They also put in what's called a dump-in or a lump sum upfront of $100,000. So they put in $50,000 premium deposit and $100,000 lump sum or dump-in. Okay. So that's what they did here. Now they had cash value immediately, not 3 years down the road, but within 30 days, they can take money back out. Okay. Now, what I want to do is I want to look down the road a bit, because keep in mind, long-term strategy. So in year 8, as an example, their bank, it went up by $66,000 in cash value. They have access to $531,000, by the way, more than they put in. But in that year, it went up by $66,000. Okay. The cash they put in, though, was only $48,000. So they put in 48, but it went up by $66,000. Okay. That's a pretty good cash on cash return. In fact, that's a 37% cash on cash return. That's pretty awesome. Now, let's look at this if they private lent that money out. So let's say they take from their policy, they borrow, it's called the, borrowing it out. They lend it out to an investor at 12%. So maybe it's a private money lender, something like that. Okay. They pay 5% back on their policy, their own loan. Okay. That means the cash on cash return they got is now 44%. 44% cash on cash return in that given year. But they did nothing different except where their money went first. Okay. So the question is, would you rather make 12% or 44%? So give me a 1 or a yes in the chat box if you'd rather do 44%. If you want 12%, that's fine, but who wants to do 44%? Okay. Yeah. And so Tony said he lent his money out at 17%. So his is even higher than this. He's actually about 50% cash on cash. Now, granted, did it take time to get there? Yes, it does. But this is what is possible with infinite banking. And this is just one example. Okay. So some people asked about uninterrupted compounding. Okay. So in this scenario, this gentleman put in $50,000 upfront. That's called a dump or lump sum. And I'll explain that here in a moment. And he's putting in almost $6,000 per year, or $491 per month. Okay. Cash value available, $51,000, right with that first year. Okay. But here's the thing. If you borrow from the policy or not, it doesn't matter. Okay. The compounding will be the exact same if you borrow or not. That's uninterrupted compounding. So in this example here, in 5 years down the road, this person has a 26% cash on cash return and 126% access to capital. Okay. Year 15, 115% cash on cash, 215% access to capital. That is amazing. And this person, by the way, in the interim, in those years, is borrowing money and investing it and making even more money outside of the policy. So would that increase your net worth? Would that increase your wealth by doing that? Absolutely. Look at what Tony said, or Tony just said, or Anthony. But he said it did a dump in, got money back in 10 days, lent out 20 days later. That's amazing. Shane did a dump in as well, got the money back, did a private money loan on Private Money Club immediately. That money's now working for him in 2 spots. Same with Tony. Their money is working in 2 spots, in the policy and also in the lending. Yep. Yeah. Same thing. Yeah. Those guys did that. So that's what you can do. Hopefully that makes sense, because this is very powerful. So now the one thing about infinite banking that I want to make sure that we are aware of is, how do you eat an elephant? It's one bite at a time. Okay. It's not like you're going to do this day one. Well, Shane and Tony did, though. They did some pretty cool stuff day one, but it's a long-term concept, but it's amazing. Okay. So think of the man at the top of the mountain. How to get there? One step at a time. Okay, look at this. So this is something. So look at what Shane just said. Shane said it retires him in 2 years from his W-2 with this strategy. That's insane. That's crazy. If he hadn't done this, it would have been a lot longer. Tony says retires me in 2 to 3 years. 2 to 3 or 23. I'm pretty sure he meant 2 to 3, but yeah. So this is what this can do for you. Okay. All right. It works for debts and expenses. Okay. What else can it do? Well, let's look at the house for a second. Yeah, that's awesome. Yeah. So Ford Sam said, Shane, did you use whole life or IULs? So 100% Ford, we're all doing whole life. We don't touch IULs for this concept at all. We wouldn't even go near those for infinite banking. And I set their policies up. Shane, I didn't do yours, but Tony, I did his policy. Yeah. Yep. Yeah. And so they've seen the presentation multiple times, Ford. So yeah, so they love this concept, obviously. So I'm going to go through this pretty quick. So remember the doctor, and you had the condo and the house. So if you just paid those things back as promised, you would end up being out of pocket $493. Yeah, $493,000. If you just replaced it with your own banking system, where you recaptured that money first, keeping in mind we're talking, years and years of doing this. And let's just say that you were earning 4%. It's, by the way, 5 to 6%, but we'll use 4% to be conservative on this same scenario, but you're the bank now. okay, you would actually have inside your policy $749,000 of cash value, and you would still have the houses. So what I mean by that is this: either out of pocket almost $500,000, or you have $750,000. That's a seven-figure swing, by the way. Now, granted, it's a drastic example, but I did it on purpose. Okay, did it on purpose. It's a drastic example, and it's done over 250 months. Okay, so keep that in mind. Yeah. Now, if you're saying, well, Brian, how do I do that? Well, once again, we have software that maps it out. It's called the Gain Projector. This is for like real estate investing or real estate investors, or if you want to buy a house or you want to buy a piece of equipment, you want to buy a car, we will map it out for you. And I like what Tony and Shane are putting inside here at that. I mean, they were scared to get this thing started. A lot of people are saying, okay, it sounds good. It sounds too good to be true. I'll get into that here in a moment. But it's changed their lives. Yeah. And by the way, I love what Shane said too. Very transparent. So we're very transparent on how this works, on why we do it. And they did study. They've been around. Our campfire, we call it. They've been on these presentations. They're on the live calls sometimes on Wednesdays where we answer questions live. So by the way, anybody who's here, if you go to Chris Naugle's YouTube channel and subscribe, we do a thing. It's at 4:30 Eastern or 1:30 Pacific every Wednesday where we hop on and answer questions live. So we're very transparent about all this kind of stuff. Okay. All right. So here's the next step. So to schedule a call with me, by the way, brian.beyourownbanker.com/TBCT. And I'll put a link in the chat box. Yeah. Tony. Yeah. I appreciate that. Yeah. And I know that you had questions. You had a lot of questions, and I love that. The more questions you have, by the way, the better, because the more you ask, the more you're going to learn. So I recommend asking as many questions as possible. I'm going to put that link in the chat box, by the way, too. Whoops, I just erased it. Okay. There we go. So I just put it in the chat box for you guys. Oh, also, I'll put my personal email address. So if you guys, by the way, I have more slides. Okay, we have more slides, and I have some more examples, and I'm going to answer some of the questions you guys are asking, because there's a lot of good questions I want to make sure that we do cover. I'll put my personal email in the chat box as well. And if you want to get those ebooks, all that kind of stuff, just send me an email, or you can click that link there and you'll get those. Yeah, Jose. Yeah, no worries, man. No worries. Okay, so there's that. So I love this imagery here, by the way. I just love it because, I was the guy in the bottom for many, many, many years, just working for my money. And now I like to have my money working for me. And this is one of the ways that it does it. Okay. So I'm going to answer some questions before I get into this, because these are going to answer some of your questions. So KM said, how safe is your money deposits? Who is the custodian? Is it the FDIC insured up to $250? So I'm going to answer that one, because the custodian, there is no custodian per se, but it's the insurance company. These are mega large insurance companies. They've been around for 120 to 200 years. They're very old insurance companies. Now, how safe is your money? So when you mention FDIC insured up to $250, you're referring to a bank. Now, in my personal opinion, that's garbage. The FDIC thing is just garbage. By the way, the FDIC is not a government entity. They don't have enough money to insure against all the deposits that exist. They don't have that capacity. Additionally, FDIC and banks are public. So if your money's in a bank, it shows up on your credit report. People know what you have. With infinite banking, it's private. It does not show up. It's actually a protected asset from lawsuits, from court orders, from divorce in most states, by the way. Now, how safe is your money in a bank versus infinite banking, okay? Or a life insurance company? Think of it this way. During the Great Depression, 9,000 banks, half the banks that existed went under. They lost everything. People lost everything. Life insurance companies, mutual insurance companies, still paid profits. They've been profitable every single year they've ever existed. They've never gone under. They've never defaulted. They've never bankrupted. So most people, politicians, by the way, wealthy families, consider the insurance company to be the safest place for your money, because they have never lost money in their existence. We always say this, because people ask me this. Well, Brian, what if the bank or the insurance company goes under? Guns and ammo are probably your safest bet at that point in time, because for them to go under, something catastrophic has happened in the world. Nothing would be safe then. Why do I say that? Okay, so during COVID, they did a stress test on One America, one of the big companies. A stress test says that, hey, if everybody in the insurance company, the clients died, what would happen? The same thing a stress test on a bank is, if everybody withdrew their money, what would happen to the bank? A traditional bank would fold. They would collapse. It's called a run on the bank. They could not survive that. With One America, the stress test said that if everybody dies, what would happen? They would pay out all the death benefits and they would keep on doing business as normal. That is how secure they are. So, roundabout way of answering that question, but I personally consider it the safest place to put my money. That's not financial advice, by the way, but that's where I feel is the safest place for my money. Ford says, what about my mom who's 65 on Social Security and has a Roth and SD IRA? Can she use this model? With Social Security, the income is very low. So the insurance company does not allow you to put a lot into a policy because that's risky. So that it can work. It might be better to do it on somebody else who's younger and more insurable. And that might be the option there. But that's a question I get quite a bit. The IRA and Roth funds, depends on the rules that you have with those IRAs and those financial vehicles, whether it would make sense to use those into the policy and what she's trying to accomplish. So the real answer to that is, well, what's the goal? What are we trying to accomplish here with infinite banking? Because I won't set up a policy until you can answer that question. Why are we doing this? What are we solving? Because then I will build it to accomplish that goal. Make sense? Yeah, great question there. So Ford says, anyone can read FDIC quarterly report that shows they do not have enough money to cover all deposits across all banks. In fact, what was that bank that just collapsed recently? Starts with an S. Silicon Bank, I think. They came in and covered all the deposits, even if they're over $250,000. They basically took money out of their coffers, a lot, and covered the entire deposits on that bank, I think is what happened. They can't do that very often. Nancy, great question. I lost that. Where did it go? What about single premium? Do they have to pay taxes? Yes. So if you do it's called a single premium policy and you pay once and you're done, those are taxable. Yeah, we don't do those for infinite banking. We don't do single premium policies. Yeah, because they are a taxable thing. So yeah, we don't do those. All right. So keep the questions coming, by the way. I'm going to keep going through the slides, but keep asking those questions. So death benefit. We'll talk about that here in just a moment. Okay. Loans. The loans do not have to be repaid, by the way. You're in control. I'll talk about that. The values grow tax-free inside the policy. I love tax-free, by the way. It's awesome. Policies are exempt from judgments and liens in most states. Protected asset. We love that. And then you can create tax-free retirement for down the road. Now, I will say this though about that one, because I know Ford, you asked that question. To do tax-free income in retirement, you have to allow the policy to grow for a minimum of typically, I would say 10 to maybe 20 years. Okay. You can front load it though to speed that up, but I typically want to see it grow for a while until it starts to be self-sufficient. Okay. All right. So I'm going to talk about the generational wealth, and then I got a couple of questions here we'll get into. So with this concept, you have an always increasing death benefit. So like term insurance is a flat death benefit. This is always increasing, but here's the cool thing. It's always going up. It's also guaranteed and it's tax-free. So you have an always increasing generational wealth strategy. This is a female, age 42, put in $20,000 for the first 5 years, okay, $100,000, and then dropped it down to $3,000 after that. But look at this. In the first year, this person put in $20,000 and the death benefit is $325,000. In year 5, that person has put in $100,000, okay? It's worth almost $500,000, okay? In year 7, they put $106,000 in, cash value is $113,000, and the death benefit is $499,000, tax-free guaranteed. And they can use this cash value, whatever it is at that point in time, to go do other things. So they're doing multiple things or accomplishing multiple strategies at the exact same time. Pretty powerful. Okay. Someone said here, other insurance companies offering infinite banking as well. What makes Chris Naugle stand out from the rest? So I move forward with you guys instead of them. They claim it's specially designed just like you. Yeah, it's all specially designed. I will say that we're probably some of the best with designing policies. I have compared myself to other people, and man, I'll be honest, 8 out of 10 times I can do a better policy just because I do a lot of unique ones. But the thing is, and this is an anonymous person, we provide ongoing support. Okay, ongoing support. So you can call me up anytime. You can call up our team anytime. You can call up, your strategist, your implementation person anytime before, during, and after you have a policy, and we will continue to work with you on that. We have software that there's no cost, no fees to use. We will use that for you. So we do a lot of ongoing support. Also, with the insurance companies like Lafayette, One America, we are the largest broker for those companies because we have a lot of repeat clients and a lot of referrals. But because we are the largest, those companies want to support us and our clients a lot. So we have a lot of resources. We can do a lot of things with these companies that other people can't because we do a lot of volume. So I've had a lot of special requests. I can call up the VP or vice president of a $90+ billion company and talk to him. In fact, I was with him actually 2 weekends ago. He came and visited with our team at an event because they like us. They support us. They support infinite banking. So that's kind of why. Yeah, and Private Money Club is a separate thing outside of this. Yeah. Tony says, yeah, I've called Bert and Brian many times for clarification. Yeah, so if you guys have questions about how to use the policy, absolutely. And it's funny, I've had a lot of people that are on these presentations that have policy with other people, and they call me up and say, hey, Brian, can you help me use this? Because the other people, once I have a policy, I can't talk to them anymore, or they don't really have the strategies. So I work with a lot of clients that I have no policies with. I just help them use their existing ones because I love what I do, to be honest. Yeah, so Shane says he contacts his mapping team to get ideas on how to flow the money the best way. So that's part of what we do. Leah says, where the heck do I get 20K every year on top of living expenses? Well, so Leah, it's you don't have to have 20K. That's just an example. I mean, I have people that are doing 300 per month. I have people that are doing, 30,000 per year. It has to be within your cash flow. So that's when we say specially designed. It's based upon your personal cash flow, your current financial situation. Okay. Yeah. Hopefully that makes sense for anonymous person and Cam. All right. So let's kind of talk through the policy loans a little bit here, because this is one of the things that people don't quite understand. Oh, it's a loan, but yes, the loans are guaranteed. Okay. You ask and you shall receive. There is no credit check. There's no approval. You get it within about 1 to 3 days in most cases. So it's pretty quick. It's considered a liquid asset, by the way. The loans are private. So when you borrow from the policies, that loan does not go on your credit report. Okay. It's considered cash when you take it out. So you can do whatever you want with it. Pay cash for a car, cash for an investment. It's just cash. Okay. There's no minimum or maximum payments on the loan. You are 100% in control. Okay. So I want you to keep that in mind. You are the one in control, not the insurance company, you, not the bank, because there is no bank. It's your bank. So when you think of like the car situation, remember the very beginning of the presentation, borrowing at 6% and paying back at 4%. In that scenario, the bank actually owns the title to that car. They have the title. They own the loan. You own you don't really own the debt. You have to pay it back, but you're not in control. With infinite banking, you're in control on both sides of the equation. You own the bank, and you own the debt, and you also own the loan, and you have the title to the car as well. So you own everything. So that's why infinite banking for a lot of people makes a lot of sense for something like buying a car. Okay. And if you miss a payment on your car or your policy, nothing happens because there is no required payment. So I have a lot of people ask me, well, Brian, who should I go talk to about the loan structure? Well, us first off, but second, go look in a mirror because it's up to you. Yeah. All right. So another question I get quite a bit is, how can I fund my banking policy? Well, you can do it monthly, quarterly, or annually. That's the premium deposit. Okay. And you can change those throughout the course of the policy. Okay. 10 times your age per month minimum. Okay. That's the recommended minimum. So if you're 60 years old, 600, 30 years old, 300 per month is the recommended minimum. Okay. Maximum depends upon the individual. So it depends on your gross income, your revenue, that kind of stuff. Okay. So it really depends on your maximum, but typically 20 to 30% of your gross income or gross revenue of your business, it's before taxes, is what you can look at on an annual basis, divided by 12 for monthly. So if you make $100,000 per year, a couple $1,000s per month is kind of like the higher end of what you can put into it on a monthly basis. That's the first way you fund the policies. The second way is what's called the dump-in or lump sum. So you can put in, let's say you're doing, $10,000 per year premium, and you have $50,000 over here in cash that you don't want to put into, debts or whatever. You can put it through the policy, turn around and borrow 90% right back out in 30 days. So when you put money into a policy, within 30 days, anywhere from 50 to 90%, you have access to right off the bat. Okay. Now, I'm not including dividends, because these dividends that come in every year also go into cash value every year, and those grow every single year. That's the compounding. Okay. So the longer you have this in place, the more you get out of it. So you saw that in the examples, right? And I'll show you another example here in just a moment. But the question always is this: would you put in $1 in order to get $3 back out? Most people say yes, which is kind of cool, but that's what this can do. Okay. All right. I'm going to put my call link in the chat box again, and then also my personal email address. So if you guys want to hop on a call, go through questions, whatever, just use that link and you're good to go. Yeah. Shane says yes. Yeah. And so, yeah, Shane used his to recapture, auto loans for his side hustle business, Turo. So I love that. So here's an example of what I'm talking about. So in this example here, this person put in a $10,000 premium deposit. They did annual. You can do it monthly, but they did annual, and a $50,000 lump sum. Okay. They turned around within 30 days, were able to borrow right around probably 80 to 88% of those two numbers right off the bat. At the end of the first year, they have $55,000 of cash value at the end of the year. So if you do the math on this, this is fun right here. I'm going to do the math really quickly. So 55,000 divided by 60,000 is 92%. They have access to 92% of the money they put in there at the end of the first year. Okay. But if you look down the road, in year 2, they put in 10,000. At the end of the year, the cash value went up by $10,600. So they are getting more out of the policy than they put into it in year 2 for the premiums. Look at year 3, year 11. Year 11, they put in $3,000 and change, and they get $10,590 of cash value out of it. Okay. That's incredible. That's awesome. Okay. Additionally, they have put 151,000 into this policy, and they have access to 185,000 of cash value. That's another amazing point right there. Okay. So this is kind of an interesting quote by Warren Buffett. I don't quite like it though, but it says, if poor people would just do what rich people do, they wouldn't be poor anymore. I like to say that if poor people had access to the rich people's knowledge, they would have better choices to make. That's kind of my way of interpreting that, because obviously resources and other things, but yeah. Okay. So another question is, an anonymous attendee, whoever that is, asked kind of something like this. So why would you want to work with like me or our team? Okay. Well, I've been teaching IBC now for like 9 years, by the way. I got to update this, but for about 9 years, I've been teaching it. I've been using it for longer. Okay. And by the way, we use this in our own lives. We're not life insurance salesmen. We actually are entrepreneurs, investors, business owners, but we do this and we came to it through our own journey, and now we'll just help other people do it. We have an entire team. So it's not like, 3 people. No, we're about 40 plus people on our team. We're very close knit team, by the way, close family. But yeah, so we only do infinite banking, by the way. So we just do infinite banking. We are the largest producer of infinite banking for most companies that we work with. I have probably 100 people right now going through underwriting right now doing this that I work with personally. We provide ongoing support and services. So as I said, I've had a lot of people come to me and say, hey, Brian, I have this policy. My agent kind of set it up, but he doesn't really know how to help me use it. And I help them use it. Okay. So we provide ongoing support and services, and there's no cost. There's no fees, nothing we charge, nothing like that. So we make our money. We're very clear on this through commissions, okay, through the insurance companies. And we will show you that if you want to see it. We will show you the numbers, all right? Also, is IUL or VUL, which is indexed universal life, or variable universal life, infinite banking? Flat, straight answer, easy, is no. They have their purposes, but in our opinion, not for infinite banking. And if you talk to the Nelson Nash Institute, they will say the same thing. Okay. IULs and term insurance, by the way, pay some of the highest commissions. Okay. So keep that in mind. They pay very high commission. We take about a 70% cut in commissions to do infinite banking versus traditional whole life insurance. Okay. And then we only do infinite banking. Additionally, IULs, VULs, they're more complicated. They have a lot more things going on inside of them. And there's a lot of hidden fees and hidden things that people don't understand. And I've had a lot of people come to me, show me their IUL, I explain it to them, and then they are sad, upset, frustrated, whatever, because they didn't understand what it was, unfortunately. So they have a lot of like surrender fees and things like that you got to be very careful of. And if anybody ever tells you, if you go to them and say, can I do a cash value policy? And they say, hey, yes, you can, but it's going to be about 3 years before you can borrow. If they say that, run away. Just run away, because that is not infinite banking, by the way. Okay, it's not infinite banking. Yeah, yeah. Tony, took 2 years to figure out how IUL works correctly. I don't know. Did you have one? I think you may have had one, but yeah. And then Shane says high commission typically means more pressure to buy the policies. Yeah. So if you hear that from an IUL person, just be very aware of that. All right. So one of 2 things will happen to us in life. Okay. Now, by the way, any questions, guys? Everybody, please put those in the chat box. Any questions, please put those in. So 2 things will happen to us in life. We live or we die. So the question to kind of think about is, with infinite banking, are we better off with it in our lives when we're alive? Yes, right? And are you better off with it when you pass away or graduate, as we call it? Yes, you're better off. Yeah. And Tony says IULs have a place. They do. A lot of times it's for retirement, by the way. But once again, they are susceptible to volatility. They're more complicated. They have a bit more, like, I don't want to say, swings, but they do have those kind of things, and a lot more hidden things, by the way. So just kind of keep that in mind. But they do have their place. But for infinite banking or being your own banking system, we say 100% no. Yep. So kind of a quick little story thing here. So when I first heard about this, I was of the same kind of boat as a lot of people, as Shane and Tony and stuff. And I was like, no, it doesn't make any sense. I don't need this. Keep doing the same thing I'm doing. And that's what I did. And I was the guy on the left-hand side, right? I said, I don't need to change anything, right? That's kind of how I kind of looked at it. And what ended up happening is I ended up losing $500,000, more than that, by the way, by trusting the wrong person. It was a huge, huge impact. $500,000 I lost. Yeah, and by trusting the wrong person. But once I started understanding how this works, I kind of went into group two. It's like, okay, now I understand how this works. I changed my mindset and I took a different set of actions to get different results. And that's what happened. Got different results. So yeah, so I was always the go it alone guy. That's what I was in my early years of learning how money really works. Spent thousands of dollars learning how it works, lost a lot of money, got very frustrated, and was the guy banging the head against the wall. So for me, it was more group two now. So as far as your next steps go, if you are looking to learn more about this, one is those books that I mentioned. So that's a great place to start. Be around our campfire, go to our YouTube channel, and then if you want to ask more questions, see if it's a fit for your situation, just schedule a call with me. There's no cost, there's no fees. I'm not going to sell you anything. It's just a call to understand, how can this work for you? How can this help, solve your problems or change your situation? So that's pretty much it right there. But I like to end on this quote because I think it's a good quote. But, the problem in America isn't so much what people don't know, it's what they think they know that just ain't so. Yeah, so great. Thank you, Tony. Yeah, so this book right here, that's the one I showed in that first slide, but Be Your Own Banker by R. Nelson Nash is a great one. And then another one that I like to recommend too, I'll put it inside of here. It's called The Case for IBC by Carlos Lara. So Carlos, I've spoken to him a few times. He's a part of the Nelson Nash Institute that certifies infinite banking practitioners. And so I'm certified by the Nelson Nash Institute, by the way. And so he wrote a couple books. He knew Nelson well. They were partners, business partners. And he wrote a book called The Case for IBC. I do recommend that one. It's a great book. Yeah, Vicky, thank you for saying that. Yeah, it's insane. So I've had a lot of people that have come to me. And by the way, it just happened recently. This couple had 4 large policies. I didn't write them. They weren't by me. And they had a change in their financial situation. And they're like saying, oh my gosh, we're going to have to, maybe cancel one or sell one of the policies or sell 2 of them. But they heard me speak on this presentation Tuesday, by the way. They asked a question. I answered it. I now know them well. They called me up and I said, hey, here's a few things to do. We changed the premium deposit structure, and they're not going to have to do anything to the policies. They're going to keep all the policies. They're good, and they're extremely happy because just the level of knowledge that we have, I believe, at the Money Multiplier is very, very solid. So yeah, so I've helped a lot of clients. Another client had a policy for about 13 years, and they heard me speak and were like, wait, they heard me speak at an event, I think it was, or I can't remember what it was. And they called me up and said, hey, Brian, we heard you talk about this. And then we asked a question and you answered it in a way that we had never heard before. And so come to find out, they had a policy sold by an agent. That agent told them a certain thing to use the policy for and how to operate it that was completely wrong. And so they had a big outstanding loan. They were going to lapse the policy, which means it would surrender and cancel eventually. And I explained to them how it worked, how the numbers worked. They didn't know. And now their policy is going to be just fine for the rest of their lives. So just understanding how to use infinite banking is extremely important. So one of my biggest goals for the client is to make sure that you understand how to use this thing, how to drive the infinite banking car, as I call it, because you don't want to go off a cliff, right? So I think of it this way. So I've had this happen with other people, but think of like seeing a car for the first time. You've never seen a car. Someone hands you the keys and says, go for a drive. you're probably going to end up off a cliff or in the ditch. So my goal is to teach you how to drive the car, which is infinite banking. That's our whole team. That's our goal. Because once you do that, just like Shane and Tony are doing, you're going to accomplish pretty amazing things. So that's it, everybody. Any last minute questions? Anything else you guys want to make sure we get clear on? Yeah, customized for you. Exactly. And then for like Cam, I hope that answered your question on like how safe your money is, the FDIC question. I think I answered your question on the minimum and maximum deposits. An anonymous person, I think I hopefully answered that question too. So, all right, everybody. Well, I appreciate all the questions. Appreciate, especially Shane and Vicky and everybody else and Tony and all that. Oh, by the way, Linda, there's a question there. So how is underwriting for insured? Yeah. So thanks, Nancy. Appreciate that. Yeah. So the underwriting, so there's a financial review, obviously, and then there's a medical. The medical is they look at your records that are public, and then if required, there's a medical exam that they cover. There's no cost, but it's blood, urine, and background question. It takes about 20 minutes, maybe. So pretty straightforward. All right, everybody, appreciate all of you and hope to speak to some of you here very soon. All right. Stay safe. Talk soon.